Hi, Investor Nation, Tasty Nation, and anyone who wants to learn about trading interest rates. This video is about how to bet on interest rates directionally and how to trade the yield curve. So this is more of a directional trade instead of a strategic trade. And by that, I mean, you're just betting if interest rates are going to go up or down. And there's no probability of success that you can calculate associated with these trades. It's just a directional bet. And also I'm going to talk about trading the yield curve where you can trade one interest rate against another one. So this is a website called the Dynamic Yield Curve, and I put a link to this website in the show notes. And what this is showing on the right-hand side here, this is the S&P 500 index, or the SPX. It's showing a chart over time from around the year 2000 up to present day. And on the left-hand side is showing the yield curve. So the yield curve means the different interest rates for different time periods. So for example, for this particular period in time in 2011, the yield curve looked like this. They call this a normal yield curve. And this has a shape of upward sloping yields. So that means for the smaller time periods, 3 months, we have a low interest rate. Then there's 2-year, 5-year, 7-year, 10-year, 20-year, and 30-year treasuries. And the interest rates are going up for each of those, as you would expect. So the longer you lock in your money, you would expect to get a higher interest rate, right? So this is what they call a normal yield curve back in 2011. Now, if I click and drag my cursor along this SPX chart on the right, you can see on the left-hand side what the yield curve was doing at different periods in time. So you can see it's starting to get a little bit flatter as we go towards 2017 and 2018. So that's a bit flatter yield curve right now. And then, so it's getting even flatter there. And if I keep going into around 2019, right around May 2019, the yield curve was actually inverted on the short end there. That means short-term interest rates got higher than longer-term interest rates. So the 3-month interest rate, which is the one that the US Federal Reserve can control, that interest rate was actually higher than the 2-year Treasury yield, which is set by the marketplace. All these interest rates on this end of the curve from 2 years up to 30 years is all set by the marketplace. It's not the Fed. Contrary to popular opinion, the Federal Reserve does not set these interest rates here. Those are set by the market, which is all the buyers and sellers around the whole world. It's a multi-trillion-dollar marketplace, and these are entire countries are betting on these interest rates. It's a huge market. But anyway, so we had a slight inversion there. And if I keep on advancing in time, so you can see here, the yield curve was quite flat as we went into the 2020 crash in the SPX. And then after that, the yield curve started to slowly steepen as you go towards 2021. So this is the current yield curve right now. And you can see it's got a different shape in the different parts. It's actually quite flat in the longer term here. So between 20 and 30-year treasuries, so there's not much of an interest rate difference. All of these are below 2.3%. But if you wanted to put on what's called a steepener, you could bet that the 30-year yield might rise faster than the 10-year yield. And we call that the knob spread. So remember, yield is just another name for interest rate. And by the way, if I scroll back to a certain period in time, they define this one as flat here. This was back in 2007, just before the big crash in 2008, and they call this inverted. So actually, most of the yield curve here was inverted, and some people say that that's a bit of a prediction of bad times to come, because generally you would expect to get higher interest rates if you go out 10 years versus if you're in the 2 to 3 month range. So I'm in my IB trading platform right now. I'm showing a chart here of the bonds. So these are all the big future treasury products. This ZB is the 30-year treasury bond. We just call that bonds. ZN is the 10-year treasury note. We just call that notes. And then ZF is the 5-year treasury. ZT is the 2-year treasury. So the name knob spread comes from notes over bonds. Buying notes, selling bonds is notes over bonds. And if I was to plot that on a chart, you can actually plot the difference between ZN and ZB. The tricky part about doing this, though, is you have to worry about the ratio between them. This is the old way of trading the knob spread. This is very old-fashioned. I've been trading the knob spread this way for, probably almost a decade. So I'm quite familiar with trading the traditional knob spread, but there's a better way. Some of you may have noticed I'm wearing my Small Exchange shirt today, and this is the better way. The Small Exchange has come up with a much, much better way of trading the knob spread. But just to show you the old way, the ratio here, I've got 2 notes to 1 bond, and going long the knob spread means you're going long 2 notes and short 1 bond. I'm just going to make my chart bigger here. So this is what the chart looks like for the knob spread itself. Long 2 notes, short 1 bond. It actually was very low back in September then it went up higher in early October, and now back in mid-October, it's actually down again. So if you thought you knew which direction this knob spread was going to go, back in September, you could have put on a steepener. And then as that yield curve got steeper, so the 30-year yield went higher than the 10-year yield. So rather than having a flatter yield curve, it actually went steeper like that. You would actually make money, because then your difference between two notes and one bond would have been up here, whereas you bought it down here. That's what putting on a steepener is. You could also put on a flattener, but I don't know anyone who ever trades flatteners. Generally, in this environment where we think interest rates are probably going to rise over time, you probably wouldn't put on a flattener unless you really thought you knew something. But you could have put on a flattener here, and then by the time we got to mid-October, that spread between notes and bonds would have got smaller, and you could have made money doing that. So I put it on one line here, the combination of two notes to one bond. I can actually buy that full spread as a single transaction. Just to see the size of these products, if you added up the buying power requirement to go short one bond and long two notes, it would actually add up to quite a bit. But the nice thing about this platform, they actually give you margin relief. So if I was to buy the knob spread altogether in one transaction, so 102 and 150 ticks. So the notional value of that combination of buying two notes and selling one bond is $102,000 notional value. And I'm only actually putting up $3,300 to do that. So they are giving a bit of margin relief there, but still, this is a huge, huge product. And I wouldn't recommend this for anyone just learning how to trade the knob spread. So instead, we can go to the small exchange. So you may have noticed I'm wearing my small exchange shirt today, and this is the new way of trading the knob spread. And by the way, if you're on a good platform like KCWorks, these would be all the symbols for the 10 small exchange products right here. And if you're in Canada like I am and you're stuck with Interactive Brokers, these are all the symbols for the 10 small exchange products. So first, before we get to the knob spread, if I wanted to just take a simple bet that I thought some of these interest rates might go up over time, I can bet on the 2-year yield directly and the 10-year yield and the 30-year yield. So using the small exchange product, 2Y SME is the 2-year treasury yield, 10Y SME is the 10-year treasury yield, and 30Y SME is the 30-year treasury yield. So if I wanted to go long interest rates, which I tend to have the assumption that over time interest rates are probably going to go up from where they are. They can't really go that much further down. And they already started to rise a little bit this year in 2021. So I think probably in the next few years, we're going to have higher interest rates. So if I wanted to bet that the 2-year yield was going to go up, I would go and buy that contract. So buying the 2-year, put in a limit price, check the margin. So the actual notional value on this contract is only $400. This is tiny compared to the original futures products that I was showing earlier. Look, the commission is only 29 cents, and I only have to put up $165. By the way, I am a member of the small exchange. So if anyone hasn't done that, you just pay $100 for life, and it gives you a slight discount on this commission. I think it's like you get 50% off that or something like that. But anyway, I just love to be part of something that's so exciting like the small exchange. So I'm only putting up $165. Chances are it's only going to move around $100 or a few $100 in the next few months. So it's a very small trade, very safe to do this way. And this could dip your toes into the treasury yield market. Okay, so I'm going to transmit that. And then let's do the same thing with the 10-year yield. Buy, put in a limit price, check the margin, and this is a little bit bigger notional value on the 10-year. It's a $1,500 notional product, still 29-cent commission, and I have to put up $750. And then let's go to the 30-year yield, buy, put in a limit price. The markets are actually closed right now on the weekend, so that's why it's not populating these values. And this one is a $2,000 notional product, and I'm putting up $838. So this is a very small way just to take a directional shot in interest rates. And if I wanted to stay long those interest rate products over time, so these contracts are expiring November 19th. So before November 19th, I just have to roll it to the next month, which is December. So every time I do that, I'm going to pay a 29-cent commission each way. This is just a cheap way to stay long interest rate products over time. Now, what about trading the knob spread? So I've already stuck it in down here at the bottom. I've already put in a buy 130-year and sell 110-year as my knob spread trade using the small exchange products. So remember back to my yield curve here, if I thought that 30-year interest rate was pretty low compared to the 10-year, and I thought that this relatively flat yield curve here might actually get steeper over time. So rather than where it is right now, I'm just going to take a snapshot of that. If I thought that that was going to go back to where it used to be, say maybe back in 2011, it was a lot steeper yield curve than it is right now. So this is currently our yield curve right now, and this was back in 2011. So if I thought that that yield curve was going to steepen, I would go long this 30-year yield and short the 10-year yield. Or I could just go long 30-year yield and don't sell anything against it. Either way, I'm still long the longer term interest rate. And I could sell something shorter term against it to kind of hedge my position. So that's called putting on a steepener. Okay, so back over to my platform. So the nice thing about the small exchange is whenever you're trading a small exchange product as a pair, it's always 1-to-1. You never have to worry about these multipliers like you did with the old Knox spread. If I wanted to trade one 10-year against a 30-year and I wanted to put on a steepener, I would buy one 30-year yield and sell one 10-year yield in a ratio of 1-to-1 and never have to worry about changing that. And if I click my pair here, it charts the pair. So you can see what it's doing over time. It's actually coming down over time. So that's called actually flattening, because if I buy that at a price of 4.75, I want it to go up, right? So if that pair went up to 5, I would make $25. That's another nice thing about the small exchange products. The multiplier on everything is just like stock. 1 point on a small exchange product is $100, just like having 100 shares of stock. So 1 point is $100. I can expand this chart if I want to see what it looks like over time. Our IB is not really that great for charting these small exchange products and especially the pairs. But remember, you can always go back to the dynamic yield curve, and that really shows you visually how flat or how steep the yield curve is. Okay, so the only problem with doing it this way is I can put in a limit price here, but for some reason, IB doesn't recognize this as an official pair and it won't let me transmit this order. All I wanted to do is buy one 30-year SME and sell one 10-year SME. It won't let me do that. So it turns out you have to actually do it separately for the small exchange products. So in that case, I would just go and do these as 2 orders, buy a 30-year SME, pay 29 cents for that, put up $838, transmit that, and then immediately go and sell a 10-year SME, put in the limit price, check the margin, pay another 29 cents for that, and then actually it is giving me back some margin doing that. You know why? Because I already have on a long 10-year SME position right now, so it's actually giving me back the margin to sell it. But anyway, you can see that's how you would do it. So it's a little inconvenient to have to do as 2 transactions there. Remember, this is a really cheap way of doing it. It's a really small way of making the trade. You can actually go in with multiple tranches doing it this way. So like maybe I wanted to put on a steepener now, and then if that steepener went against me, so the yield curve actually flattened a little bit more, I could put on another one, assuming that it will steepen again over the next few months. And the interest rates shown back on my dynamic yield curve page actually do correspond to those same numbers. So you can see the 30-year yield here is trading just under 2.3%. These prices shown here are literally what the yields are trading for right now. So these are the interest rates. You just have to move the decimal place over. So for the 2-year yield, it's trading at 4.14. So you just move the decimal place. So that means that the interest rate is 0.414%. And the 10-year smallest product is trading at 15.9. You just move the decimal place over 1. So the interest rate is 1.59%. And same thing for the 30-year yield. Move the decimal place over 1. So the interest rate for the 30-year treasuries is 2.064%. These are the interest rates for those products trading right now. And they change, of course, day to day, but that's what they're trading for right now. So if you wanted to lock in your money into a treasury bond for 30 years, you would only be getting 2.064%. Sounds like a terrible deal, right? I'd rather borrow money right now rather than lend money. Okay, so that's my video on trading the yield curve. I tend to like putting on steepeners, and remember, this is a directional way of trading interest rates. And if you haven't checked out my other video on how to trade treasury products strategically, make sure you check out that video. I'm putting that one on the screen right now. That is actually the preferred way that I like to trade treasuries, is doing it strategically by selling premium. You can actually do both. That's the other great thing. You could sell a strangle or an iron condor against this interest rate position that you have on using the smalls. Personally, I would prefer to just go long all 3 of them because I think interest rates will go up over time. And then also sell premium against that by, for example, selling an iron condor in /ZN. Okay, well, thanks for watching. I hope you learned something about trading interest rates today. Please write any comments you have below. I always respond to every comment, and I love doing this. And I want to keep putting out more videos like this to help to get people really interested in this stuff, to get them as excited as I am about all these different types of trades. Okay, thanks for watching.